We have a couple of interesting stories to share with you, so let's get started. First up, the Reserve Bank of India has introduced new rules for non-banking financial companies, aiming to strengthen the sector's regulatory framework. This move is expected to enhance transparency and stability in the market. We'll be keeping a close eye on how these changes play out and what they might mean for investors. In other news, Federal Reserve officials had been making headlines with their comments on interest rates. Fed Governor Mary Daly has expressed support for the decision to hold rates steady at the July policy meeting, citing the need for more data before making any further moves. Meanwhile, Fed Governor Lisa Cook has emphasized the importance of maintaining flexibility in monetary policy, given the current economic uncertainty. We're also tracking a story from India, where the Reserve Bank has announced plans to introduce a new digital currency. This pilot project aims to test the feasibility of a central bank-backed digital currency and could potentially revolutionize the way we think about money. Lastly, we want to touch on some comments made by Federal Reserve Bank of San Francisco President Mary Daly, who believes that the central bank was right to hold rates steady at the July policy meeting. She emphasized the need for vigilance in monitoring inflation and being prepared to take action if necessary. These are just a few of the stories making waves in the world of finance. We'll be diving deeper into each of these topics and exploring what they might mean for your investments. We'll also be discussing the potential risks and opportunities that arise from these developments. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're exploring the world of personal finance and risk management, and our next story is all about making the most of your savings. You might be surprised to learn that many people are leaving money on the table by not taking advantage of high-yield savings accounts. According to recent reports, the Federal Reserve's decision to hold steady on interest rates has created a unique opportunity for savers. Online banks are passing on these higher rates to their customers, offering APIs several times higher than the national average. However, traditional banks have been slower to adapt, leaving many account holders with paltry returns. The numbers are striking. A $12,500 emergency fund could earn around $50 per year at an average interest rate, but a competitive high-yield savings account could bring in around $500. That's a significant difference, and it adds up over time. In fact, if you were to park $10,000 in a high-yield savings account for 10 years, you could end up with roughly $14,800 compared to just $10,400 at a lower interest rate. Now, some might argue that high-yield savings accounts come with variable rates, which can fluctuate with market conditions. And it's true that these rates may not always be as high as they are today. But the same can be said for traditional savings accounts, which often start from a much lower baseline. So, what is the takeaway? If you're looking to make the most of your emergency fund, it might be worth considering a high-yield savings account. With many online banks offering FDIC insurance, no monthly fees, and low or no minimums, the barriers to entry are relatively low. Of course, it's essential to do your research and compare rates before making a decision. But for those willing to take the leap, the potential rewards could be significant. And with the ability to set up an account in just a few minutes, it's easier than ever to start earning more on your savings. Welcome back to the Riskwiser Zone. Today, we've been exploring the world of investments and navigating the complexities of the market. As we close out the show, let's take a look at two beverage giants that have been making headlines: PepsiCo and Coca-Cola. PepsiCo has been facing challenges in its North America operations, with weak sales in convenience and gas channels due to higher gas prices affecting consumer budgets. Despite this, the company has increased its dividend for 54 consecutive years, offering a yield of over 4.2%. This is significantly higher than the S&P 500 index and even its rival Coca-Cola, which boasts a dividend yield of around 2.4%. On the other hand, Coca-Cola's stock has been performing relatively well, trading just 5% below its 52-week highs. The company's international business has been resilient, and it has managed to maintain a strong brand presence globally. So what does this mean for investors? PepsiCo's weak North America performance has led to a downgrade from Citi, with the brokerage lowering its target price from $170 to $145. However, some analysts argue that there is a significant margin of safety in PepsiCo at current levels, given its tepid valuations and high dividend yield. Ultimately, as investors, it's essential to weigh the pros and cons of each company and consider your individual financial goals and risk tolerance. While PepsiCo's high dividend yield may be attractive, its weak North America performance is a concern. On the other hand, Coca-Cola's strong brand presence and international business may make it a more stable investment option. As we wrap up today's show, remember that investing always involves some level of risk. It's crucial to do your research, diversify your portfolio, and stay informed about market trends. Whether you're a seasoned investor or just starting out, it's essential to approach the market with caution and a clear understanding of your investment goals. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe. And until next time, keep your finances in check.